Hello and welcome to Subscribers Helpline, where we answer some of the most frequently asked questions. And to do that, today we have our CEO Dhirendra Kumar with us. Welcome, Dhirendra.
Thank you.
So let's begin this episode with our first question. It's from Biju Paul. He asks, if the mutual fund in which I am investing are holding onto a large amount of cash and not investing in stocks, should I continue investing in those funds or hold my cash in a fixed deposit, especially given that fixed deposit rates are good now?
There is a way of looking at it. There are funds which do not hold cash, and there are funds which hold cash by their stated objective, by their strategy. Some funds say that when they are apprehensive about the state of the market, they keep cash, and they keep cash deliberately. So just as we invest, we entrust our money to the fund manager, and we leave it to him, that manage my money to best of your ability. And some are demonstrating their ability by just choosing stocks and remaining fully invested. I come across many fund managers like that. There are some fund managers who say that I am not fully invested. I have maintained 10%, 15%, 20% into cash because he thinks that he's very uncomfortable with the market. I would, there could be argument for and against that. In a short period of time, some of them look stupid, some of them look smart. But over a long period of time, if you're a reasonably good fund, it doesn't matter. I have seen that the funds which actually take a cash call and the funds which don't take a cash call, and both are good funds, on a 5-year time period or a 10-year time period, even a great cash call does not make much of a difference. I think, you should look at it little differently. That once you choose a fund, you are choosing a good fund manager. Whether he takes cash or not, you should have your cash strategy yourself. The money that you need in a couple of weeks, couple of months, maybe a year and a half, that should be in fixed income or cash or lying in your bank account is a different story. How much money you should have cash in your locker is another story. That, if you have old parents or, a small child and you want to have your emergency fund and that too in cash and there isn't an ATM close by, that's your emergency money. That's a different cash. Cash as an investment, you should leave it to the fund manager.
Okay. The next question is, are debt funds safer when there are geopolitical uncertainties? I find my funds NAV going down.
Debt funds go down. But they don't go down in a manner the way you see equities going down. For this, I just looked at the numbers. The worst case scenario in a debt fund in a 1 month period in the history of debt fund, short duration fund, was minus 2.3%. Which means that if you had your 100 rupee invested, it became 97 rupees 70 paisa. You feel not so happy, but it's not a devastating thing. The worst case scenario in a flexi-cap fund was minus 35%. Your 100 rupee got reduced to 65 rupees. That is bad. Likewise for large cap, and even worse in the small cap fund. If you look at a 1 year period, in 1 year period, if you bought and held it, and the worst 1 year period, the return is still positive, 2.6%. This is the worst 1 year return in a short duration fund. As compared to that, the flexi cap fund or the large cap fund, or the small cap fund, they're down 50, 60%. This is unnerving. If your money gets reduced by 50% and in a 1 year time period, that will be a time, when you will lose patience. You will just think that, okay, let me get out of the market and forever. Aggressive hybrid funds, they went down by 45% in the worst case or worst annual period in their life. So I would say that debt funds are risky. They can go down in value, more so not because of geopolitics. Debt funds go down in value when there is a likelihood of interest rates going up. That is when bond funds go down. And if interest rates go down, then they appreciate. And if, the worst hit that happens to a debt fund is when most fund managers are expecting that there will be a rate cut. And they are elongating, they are getting into longer maturity bonds, and they get a surprise. Instead of a rate cut, there is a rate hike. And it has happened twice in recent decades, so to say. Last 10 years, it has happened 2-3 times that everybody was expecting a rate cut and there was a rate hike. And everybody was caught unaware, and that is when they actually face the big decline, the big fall.
Okay. So moving on, the next question is from Prashant. He asked, Don't large-scale SIPs affect stock valuation? Investors like me today keep their SIPs going month on month despite high or low market valuation, in several cases increasing SIP contributions. Isn't continued SIP at today's prices akin to buy a set of direct stocks even though they are highly priced, thereby driving up their prices further? Doesn't this pressurize funds to buy stocks even when companies are at relatively high valuation? Will at some point mutual fund houses pause to let things cool down a bit?
Mutual funds will actually not pause or accelerate, or because mutual fund managers are slaves of investors' action. If lot of investors put their money, they will be investing. In fact, some fund managers have the flexibility of keeping some cash. Most fund managers actually have stated that if we will be fully invested. Some fund managers have kept that flexibility and they exercise it. But that flexibility is to the tune of 20%. It is not that I will keep half of my money. There are some specific funds which try to attempt that, that dynamic allocation fund. In fact, the distortion in the market happens for these two reasons only. One is that the market is cheap or expensive depending on the earnings potential of the underlying companies. Companies will generate this much of return, and that is the strongest factor. So if the market is high, if they are available at a high valuation, then your returns will come down. That is a guaranteed way that if you are buying expensive, your returns will be lower. The point is that markets can remain like that for a long period of time. These are two things which always drives the market: the valuation, or the relative valuation, and the potential earnings potential of those underlying or the equity market. Second is the dynamics of flows, whether foreign investors putting money, domestic investors putting money, domestic institutional investors putting money. And I think the SIP flow is not coming down. SIP flow will remain the way it is. And for most SIP investor, there lies the opportunity, there lies the threat. The opportunity is that if you continue investing through the lean period as well, you will average. The threat is that if the market remains very expensive and you keep buying at a higher level, and at some point the market goes up to a point where it will fall and stop going up for a couple of years when you need the money. That is the time when you will actually suffer. That is something which will be very disappointing. But then whenever I have looked at any 5-year period, the market has done well. When I look at any short-term period, and that is despite the cheap valuation, expensive valuation, even if you were doing your SIP starting from the expensive state of the market in 2007, and in January 2008 you peaked at the valuation, and if you kept doing it even through the decline, you end up being a winner on any 5-year time period. So the critical thing is you be long-term. You don't have a control on the state of the market. You don't have a control on the SIP flow in the market. You don't have any say on the foreign investor flow in the market. Recently market went down simply because foreigners were, FIIs were putting their money or pulling out from India to invest in China was the louder gossip, so to say. Don't bother about that. Choose your kind, the kind of fund that you choose. That is something which is important in terms of being able to navigate through the ups and downs, whether you should go for an all equity fund, a multi-cap fund, value fund, or a flexi-cap fund, or you go for an aggressive hybrid fund, or whether you add a large cap index fund with a small cap and mid cap fund. That also becomes a very good diversified portfolio. What you choose, the vehicle you choose, and going up and down, and having your long-term orientation is one of the biggest guarantee to derive returns from the market.
Okay, now the next question is from Hariharan Anant Narayanan. He says, if we build a small cap heavy portfolio, how do we transition to a lower volatility portfolio that is suitable for setting up an SWP? Alternatively, can we set up an SWP on a small cap mutual fund with a high corpus?
Yeah, this is a very interesting question because we understand, I keep saying that small cap is risky. And small cap is risky, and small cap is very risky in the short run. If you look at the worst case scenario, I looked at, I actually, tried to simulate his situation, that if he has 1 crore rupee accumulated in small cap, And if his withdrawal percentage, he was withdrawing 10% of this money since 2005, his investment worth in a small cap fund will be 6.3 crore. This is sizable because small caps generate so much higher return that even if you're, I'm not suggesting that take 10% from withdraw 10%. I normally say that be a little more conservative in your initial years. And if he would have invested 1 crore and his withdrawal was 2%, he was taking 2 lakh rupees every year, his investment worth will be 18.7 crore. That is mind-boggling. So my suggestion will be, if you have a much larger, asset base, if you have accumulated sizable amount in small cap, and if your withdrawal rate is less than 3% or 3%, by all means keep it in small cap. More so, you will not get upset. You will not lose your sleep when the market falls, because in the next 20-30 years, you will get 2-3 phases like 2008, when the markets will crumble. Small caps will fall even more. And that is the time when you will still keep withdrawing 2%. And you will not lose your sleep because you will have confidence, or because of your experience, because of your ability to withstand that decline, you will be able to stick around. Sticking around is the key. Having that confidence, and that comes only with the understanding of how things work and experience, only if you have experienced it before. I would like to give another example, that if you invested 1 crore rupee in an equity savings fund, which is a very conservative vehicle in your retirement, most people will encourage you to be conservative, or you invested 1 crore in a small cap fund and you started withdrawing 4% annually, taking 4 lakh rupees every year, your investment worth in an equity savings fund will be 1.73 crore today. This is all based on investment in January 2005. And the worth of your investment in a small cap fund will be 15.6 crore. This is too tempting a number. Just get used to living with the ups and downs of small cap, and it will be rewarding. If you don't get used to it, then be more comfortable with more conservative vehicle.
Now, the next question is from Ajay Karhalkar. He wants to know, considering the volatility in market, is it prudent to invest in multi-asset fund which have a mix of commodities, equities, debt and real assets? What is the difference between multi-asset and multi-cap funds?
I would say that, we looked at the number and there is a difference. Equity falls in grim times. When I look at the worst 10 falls of the Sensex, whether it was October 2008, equity fell so freely, it was nearly 22.5% in a month's time. And gold also fell, and so did a combination of gold, equity and debt. When I look at all the declining phase, on some occasion gold was able to fall little less, but it was not of a scale which actually makes you think that okay, you were able to guard yourselves. Only in 2008 gold was perceptively, clearly was able to withstand the decline better, and in most other cases equity and debt also is able to provide you that much protection.
Okay, and what is the difference between multi-asset fund and multi-cap funds?
Oh, they are completely different animal. Multi-cap fund is an all equity fund. The fund manager has to invest in a large cap, mid cap and small cap. The minimum should be 25% in each. As compared to that, the multi-asset fund is a fund which can invest in equity, which can invest in debt, and it can also invest in gold.
Now, Hitendra Vani wants to invest 30 lakh rupees in the stock market through mutual funds or stocks. He asks, what should be the strategy to invest the same? What would be the best asset allocation strategy?
30 lakh rupees investment for the long run to be invested in equity. He has both the vehicles available, building a portfolio himself and or investing in a mutual fund. One thing is that the money should be staggered if this money is very important. 30 lakh rupee, if it is a very critical money, then it must be spread over 12 months, 18 months or 24 months, depending on how critical it is, how much time it has taken for you to earn, maybe half the period. If it has taken you 5 years to earn it, then maybe 1.5, 2 years might be a good period to spread it, because that reflects about the criticality of that money in your context. For some people, it might be a nominal sum. For some people, it could be a lifetime of money. So it's very important too, because the impact of decline of that money and the scale of that is entirely dependent on, it has a bearing on your thinking, and it has a bearing on your behavior. It has a bearing on the way you react to declines, and that is why it is very important. So that's the most important thing. How long you should take to spread it, you decide it, but it must be critical. It must be 18 months to 24 months, 30 months. Second is that, it should be in a good equity fund, or it should be in a good equity portfolio. Now, building a good equity portfolio is a tricky thing. You have to choose good companies. You have to allocate, if you have 30 lakh rupees in some companies, you will spend, you will invest something like 6 lakh rupees. In some companies, you should invest 3 lakh rupees. In some companies, you will invest 1.5 lakh rupees, depending on the promise you prioritize in your portfolio. Making sure that those companies are of different variables so that it is diversified in a meaningful way. And making sure that they are high quality, promising ones. So if you can do all of this together, then by all means invest in your own portfolio. There are 2-3 benefits of doing it. One is that there is a joy of building your portfolio yourself and making it work and succeeding with it. Added economic benefit is that you don't incur the expense ratio of a mutual fund. But if you don't have the time, if you don't have the inclination, and if you don't have the confidence of doing it, and if you don't have the temperament of doing it, then entrust your money to a good flexi cap or a multi-cap fund manager. In investing in all that, in a good flexi cap or a multi-cap fund manager, is that, it will be diversified. If you decide to invest 30 lakh rupees, 1 lakh rupees every month, that 1 lakh rupees will get instantly diversified. You don't have to worry which one to buy now, which one to buy next month, which one to buy. Because even with your own money, you should be spreading it over time. And so if you haven't done it, don't venture. If you have done it, and if you are comfortable with it, and you can formulate all these rules for yourself and broadly follow, not precisely follow, it will be nice. So choose your course depending on these facts. And if you decide to do the stock portfolio yourself, subscribe to Stock Advisor and choose one of the 3 portfolios. Every month you get a revised list of 10 stocks. And invest an equal amount. You can do your SIP based on that, the aggressive portfolio or the conservative portfolio, which is the dividend growth portfolio, or the growth portfolio. One of these portfolios you decide and invest a defined sum every month on a specific date, and that makes your job easier. If you want to do it in a mutual fund, then choose Fund Advisor. Subscribe to Fund Advisor. And that way, you will get a recommendation, a curated list. Not only you will get a curated list, we will also tell you when to sell. And that is with stocks as well as funds. So knowing when to sell, and it can happen with, most people buy well, they don't sell well. And selling it sometimes could be a very risky thing. It is a very, you are always in a state of dilemmas. The reason why a stock is looking weak may not be a durable reason, maybe a very temporary thing. And that is where our analysts actually add very significant value.
Okay. Now, Ravi Gupta says, I wish to start investing for my 3-year-old grandson. Please advise suitable funds and also how to go about it.
So for a 3-year-old grandson who will get into college 15 years from now, it should be equity, and it should be aggressive equity. But if he is not comfortable with equity, then he should invest in a multi-cap fund or aggressive hybrid fund. That is also fine. That will get him 90% of the benefit. And he should ideally invest this money in 1 or 2, a mid-cap fund or a small-cap fund as well, because over the 15 years period, despite the ups and downs, I'm hopeful that a diversified portfolio held for this long will be proved to be the most rewarding. The only catch is that he has to stay invested and ignore all the interim dips. How to invest in a mutual fund for a grandchild? 2 ways of doing it. One is that you open a bank account in the name of the child, where your son will become he will operate the bank account. Transfer that money into that bank account, and that money will be invested in the fund. And when he attains majority, then this investment will be transferred in his, he will become the owner of this investment. Before that, he will be the owner, but his father will be the manager or so to say, the operating this investment. The second way of doing it is he should invest in his name. Keep it in the locker with something earmarked in his mind that it is his grandchild's investment. And when the child becomes 18, he can give it away, redeem the money and give it away. And just in case, he visualizes that he may not be around, or there is a little apprehension that he may not be around, then he should nominate his grandchild. So his grandchild will become the owner of this investment, or he can himself transfer the investment when his grandchild becomes 18.
Okay, moving on. Dipali Menon says, given the expected rate cuts, everyone is advising to invest in long duration funds. She wants to know your view on this.
My view is that, don't go for all this prediction of interest rate cuts. For last 2 years, everybody has been guessing. Last 10 years, most fund managers have been wrong on 3 critical occasions. And I actually pulled out the worst 1 year rolling return from gilt funds, long-term gilt funds. On 4th of January 2010, the 1 year return on gilt fund was minus 8%. Somebody bought it at a peak and held it expecting that there will be rate cut, and there was a rate hike and there is a decline of 8%. Another next time period, 5th of January, minus 7%. Even in 2009, the decline was 5 to 6% from the 1 year holding period. I'm not talking of few days, few weeks or few months. It is 12 months. And then you witness a decline of 5 to 10%. So don't invest in debt. Invest in debt fund for a different reason. Invest in a short-term debt fund. The money that you need in the medium term, the money that you need, or you want to make your overall portfolio more stable. Make sure that you are looking at your whole investment as one big chunk. You will have money lying in your public provident fund or employee provident fund, or your employer's provident fund. All that money is fixed income. Then you have your equity portfolio. Then there could be some debt fund that you are investing. The money that you need in 1 year, 2 years, 3 years time, that should be invested in fixed income, or that should be a bank deposit, or you make a deliberate allocation to equity. You are investing for the long run. You still have 20 years to go, but you want to keep 25% money in fixed income. That money should be in short-term debt fund. Don't dabble with this. A reason is that most fund managers have gone wrong trying to guess it in recent years. Second is that, even if you do well, it is not going to make a dramatic difference to you. You should take all your risk from equity. Make your allocation to to the small cap fund. Make a allocation to some of the exotic, sector fund, thematic fund, where there is far greater potential. But why take a chance with fixed income, where if you win, you don't win big, and if you lose, you can still lose. So why take a chance?
Okay. Chumki asks, how safe are mutual fund portfolios from hackers like bank FD or saving accounts?
You have to protect your bank account. You have to make sure that whatever you are doing, whatever precaution you are doing, whether it amounts to carrying another cell phone or having a unique SIM which you will never touch, you'll never share with anyone, insulated phone or whatever. I don't know what all is to be done. Just be a little more cautious, extremely cautious with this. The reason is that mutual funds are safe. And in fact, investing in mutual fund insulates, if you have money lying in your bank, that is accessible to you or the hackers as well. But if the money moves out to a mutual fund, that at least is not accessible. And mutual funds were made safer a few years back, when the law or the rule is that the money to be invested in your name or your investments has to necessarily come from your bank account. So if my bank account is in name of Dhirendra Kumar and I want to invest money in somebody else's name, I write a check, it won't work. I transfer that money, it won't work. It has to come from my bank account. And before investment, the mutual fund is supposed to verify that this money is coming from the bank account of the person in whose name this investment is being made. So that makes it foolproof. Second is that the redemption of any mutual fund will necessarily come to my bank account. I may have a separate bank account, I may have a different bank account, but that also has to be in my name. But that does not really save you from hacker accessing your, hacking your bank account. So protect your bank account, and mutual funds are safe.
Okay. That brings us to the last question. Shashank Kumar wants to invest in gold. He wants to know how to do it when there is no SGB issue. Should he invest in gold ETF? If yes, suggest one. He has a moderate risk appetite for investments.
Yes, sovereign gold bonds are over. Government is no longer issuing it, and that is unfortunate. That's not it's a bad thing. It was an interesting and a very useful investment avenue available, which was getting you a little more return than gold without the hassle of holding gold, and in the purest form or in the safest form, simply because I trust Government of India. I will actually, I will value its promise that it will give me as much return as the gold has appreciated based on a very defined formula, and will be transparent about it. The problem, you can still buy the sovereign gold bonds, just that the government will not issue it. You will not make the primary issue. They are still traded in the market, and that is why they are trading at a premium. So you will have to buy it from the market. The next best thing is buying the ETF or the gold fund. Buy the gold fund with the lowest expense, or buy the ETF with the lowest expense ratio, and that is it.
Well, that's all for today's episode. Keep sending us your question, and thank you for watching.